Hey everybody, we are going to talk about real estate today. Surprise, surprise, but are some more exciting real estate stocks. These are not real estate investment trusts. These are kind of real estate technology companies, I would call them. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we are doing on YouTube. Again, fool.com/Frankel. Redfin is a stock that was all the rage in 2021. They had their iBuying business. The home sale volume was off the charts. They weren't making money, but they were growing. They were, everything was moving in the right direction. That, the market came to a screeching halt in 2022, and Redfin stock plunged by over 90% from the highs. Now the company really did a good job of pivoting toward efficiency. They shut down that iBuying business. They're trying to figure out ways to make the overall business more efficient. They acquired a mortgage lender, for example, instead of just trying to build one on their own. They overpaid for that mortgage lender, but that's neither here nor there at this point. The rental business was a great acquisition. They bought RentPath. It was called RentPath. Now it's just called Rent, out of bankruptcy. That gave them a lot of properties like rent.com. They got the Apartment Guide as one of their brands. A lot of people don't realize that Redfin owns that brand now. That has actually been a very bright spot of the business. That had positive adjusted EBITDA this year and was one of the faster growing parts of the business. It's definitely a renter's economy in a lot of ways in the United States right now. So that has kind of helped to offset the core brokerage business. And they've done a great job in a bad situation. They're growing their market share, not by a ton, but it's up from 0.75% of home sales a year ago to 0.77% now. The monthly visitors to their app and platform were flat year over year, which considering that the market continued to decline in volume is kind of impressive. And I like some of their strategies. One of their strategies that really annoys Tyler, I really like. Tyler was trying to find their earnings release before we recorded, and he couldn't because there were so many press releases on Redfin's website about what the real estate market's doing. The company wants anytime anybody quotes a real estate stat, how home sales are doing, how mortgage volume's doing, things like that. They want it to be from a Redfin study or Redfin survey or things like that. And they've been kind of successful at that. If I look at stats on CNBC, half the time they come from Redfin right now. I love that strategy. It kind of it's boosting brand awareness. It's like I've talked about SoFi in other videos when they did the stadium naming license deal. A lot of people hated that. I love it. It's bringing awareness to a brand that Redfin is not the number one real estate brand in the country. Zillow is a much more recognizable brand name. I would argue Realtor.com is a more recognizable name than Redfin. It does a great job of getting their brand name in the forefront. And I think that is they're setting themselves up for success when the market turns. I think is kind of my best kind of take on what they're doing. But as Tyler likes to throw cold water on when I'm talking about with Redfin, and I'm sure he's going to bring up their lack of profitability to this point. But it's a means to an end. Their losses are manageable right now. They're profitable on an adjusted basis, or actually they were break even on an adjusted basis in the most recent quarter. So that makes it sustainable. It's not GAAP profitability, but it makes the business a lot more sustainable than when their adjusted loss was, over $100 million on an annualized basis just a year ago. So I am very happy with how they've handled a terrible environment. Would I have liked the 2021 real estate market to last for another 5 years? Absolutely. We would be talking about a totally different story today. But Tyler, please tell me you like Redfin at least a little better than Open Door right now.
Operationally, it looks better. I'll give you that. And like you said, rentals is up. Mortgage attachment rates are higher. So the places, the things that you would want it to do, like you said, market share is increasing ever so slightly. I don't know about the unique visitors one. I know it's flat. I don't know what to make of that because, people tend to be kind of very casual lookers at real estate anyways. It's, almost as out of some sort of like voyeuristic sort of view of real estate rather than actual serious buyers. But operationally, yeah, I think there's things there. And like you said, it's break even ish on an adjusted basis. But there's two just kind of like big black stains on that. And that's the fact that, as you mentioned, they wound down their iBuying business, but the debt is still left over. Like they still have $815 million in debt just kind of sitting on the books that they weren't necessarily able to clear when they wrote down all the inventory on this iBuying experiment. And so there's going to be this rather considerable debt overhang and interest expense overhang associated with this company until they can generate enough profitability and cash flow profitability to really wind down this debt position. I do really like, there's part of me, it's like, well, it doesn't really matter and if they have to give every dollar that they have available to in interest expenses. So, same thing as when Open Door prevents, post GAAP profitability, we'll talk. Well, when Redfin significantly reduces its debt outstanding, we'll talk, because having that much debt outstanding is just, it's eating away and deteriorating the balance sheet. And then there's the other thing, and you and I have talked about the frustration with this a lot. It's like, for a company that is not profitable, for a company that has been public for quite some time now, and isn't this go growth stock that it trading absurd valuations where stock or shares are a good way to fund things, there's still a lot of stock-based compensation going out the door. And for a business that, in my opinion, yeah, it's doing a little bit better now, but it made a lot of bad decisions in these past couple of years, and shareholders are suffering as a result from some of those bad decisions. But yet you're still throwing a lot of money to people on a stock-based guy. I don't really know how much they've really earned that sort of thing. And so there's part of me that really needs to see a reining in of stock-based comp and also to trim this debt position. And I think as long as those overhangs are still there, there's enough of caution for me to be had with this business that I like I said, prove me wrong. Muted.
I was just saying that's a good place to wrap it up. I think we had enough for two. I'll try to split that into two videos when I'm editing.
Okay. And just like throw an intro in.
Yeah, I can just record a separate intro. It's not a big deal.
Very cool.
All right.
Yeah. I have lots of practice with long-winded answers. I work with Jason.
That's true. I was going to say that too. All right. Let me get out of here. Appreciate that. And I will see you next time. Any trading restrictions, anything like that? Are you buying Open Door or anything I need to know about?
I haven't bought or sold a thing in months.
Okay.
It's great. I just sat on my ass.
Fair enough. All right. Until next time.
See ya.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.